excited about that. Buenos días, buenas tardes to all of you joining us across the US. Welcome to Nationwide's workshop, Flip the Script, Transforming Your Business to Access Capital. Nationwide is honored to once more be part of the US Hispanic Chamber of Commerce annual conference. I'm very grateful for our partnership. I am Loreley Burgos, Hispanic Marketing Leader at Nationwide. For the last few years, I've had the tremendous opportunity to network with many of you and to interact very closely with Hispanic-owned business across the US as we continue to evolve our marketing program to economically empower the Hispanic business owner community. We hear very often how difficult it is to access capital for Hispanic-owned businesses. So today, we are excited to host two Latinx powerhouses to help us unpack the mystery around why some businesses are successful at getting access to capital and some are not. Amelia Gandara is a principal on Nationwide's venture capital team. Prior to joining the Nationwide Familia, she worked at a pre-seed funding program at GE Appliances. And Nick Delgado, growth enthusiast, meditation coach, and president of Black Pen Whiteboard. They will share their wealth of knowledge around access to capital from two different viewpoints and share with you the best practices to help take businesses to the next level through strategy and preparedness. As I reflected on today's session, I thought about why do we all join this conference every year? And I boiled it down to three key actions. We want to learn, we want to connect, and we want to win. So I created this quick chart to show you how we can achieve all three during conference and beyond. Next slide. I encourage you to learn from Nick and Amelia today and engage with them by asking questions using the Q&A form under the video player. Later, please be able to tune in to the Business Solutions series, a three-part video series and virtual business builder program. You can access the series at any time at nationwide.com/biglegacies. So how can you connect with us during conference? Please connect with us tomorrow during the matchmaking sessions. They're happening between 3 and 5 in the afternoon. After that, you can connect with us anytime by emailing us at supplier@nationwide.com. That email again is supplier@nationwide.com. Next slide, please. And last but not least, today we partner with two Latina-owned businesses, Ari Rose out of Chicago and Coco Andre from Dallas, Texas, to give 5 lucky winners the opportunity to try some of their awesome products. I want to ask all of you to please support their businesses by following them on social media. Winners will be chosen at random from those of you who engage with us throughout the session. If you wish to be entered into the drawing, please share your email through the Q&A feature, the form right below the video player. Winners will be contacted via email right after the session. That email will come from me, Loreley Burgos at Nationwide. Lastly, to win at anything in life, it requires continual learning and practice. So just do it. Nick, take it away.
Thank you, Lori, and good morning, USHCC. Before we begin, let me thank our friends at Nationwide. I know many of you think of Nationwide as a major corporation. I have the privilege of knowing the people behind the brand, and you should know that the personal commitment from people like Lori, Lou, and Amelia for our community is absolutely through the roof. So thank you, Nationwide, for being tremendous champions for our community. Now, a bit of a disclaimer from our friends in legal. If there's anything I say today that rubs you the wrong way, I own it 100%. So go ahead and DM me. I assure you I could take it. However, if you get any good nuggets, or better yet, game-changing ideas for your business, then all praise goes to Nationwide, because without them, I wouldn't be with you today. Next slide. I'm so excited about this conversation because Amelia and I are committed to making this the most thoughtful, interesting, and impactful hour, not only at this conference, but that you'll have all week. And I say that because we have a very precise agenda. Our sole purpose is to make sure that you understand what you need to do to raise capital. Next slide. You know, one of the beauties of having a singular purpose in this presentation is that we're able to focus and enjoy the fruits of our focus. But in this world, at this time, our focus can be challenged. In fact, I would go so far as to say that being distracted is one of the greatest risks to your business. That being distracted and having too many things on your plate and on your mind prevents you from achieving all the business success that you're capable of. So what I want to do now is take a very brief moment to guide you through a tool that has been used for thousands of years called mindfulness meditation. One of the foundational elements of a mindfulness meditation practice is to learn how to place our attention and pair that with an open and unbiased awareness of whatever arises. This practice can be game-changing in business because over time, it can help us develop clarity, resilience, and even stability. Let me give you an overview of the structure of a mindfulness meditation, and then I'll guide you through a brief session. The mechanics of this mindfulness practice are basic and very approachable. There are only 3 steps. Take your seat, place your attention on your breath, and when you notice your mind wandering, label it thinking and return your attention to your breath. So let's give it a try. I ask that you participate because being mindful is not just an idea, it's a muscle. Please follow along as I guide you deeper into each of the 3 steps in a very brief 30-second mindfulness moment. Step 1, take your seat. Let your sit bones firmly connect to your chair cushion. Place your feet flat on the ground. Your back is strong, supporting your upright nature. Your front is soft. Your chest is free of any tension. Shrug your shoulders up and let your arms hang down naturally. Place your hands palms down on your thighs. Your head is straight and your chin is horizontal. Your eyes are open with a soft gaze 4 to 6 feet in front of you. This is step 1. Take your seat. Step 2. Place your attention on your breath. Focus on the flow of breath from the tip of your nose. Feel the full cycle throughout your body. Let the air move through you naturally without any judgment or manipulation. This is step 2. Place your attention on your breath. And finally, step 3. When you notice your mind wandering, label it thinking and return your attention to your breath. In doing so, say thinking nicely as you would to a small child. You see, these are your thoughts, so notice them and be gentle. Give them all the same name, thinking, and then come back to the tip of your nose. Come back to returning your attention to your breath. This is step 3. When you notice your mind wandering, label it thinking and return your attention to your breath. We'll start now, and in 30 seconds, you'll hear a bell to indicate the end of the moment. Welcome back. Thank you for that moment. And please take it as a gift that you can use at any point in your day to help you achieve the clarity you deserve in your life. Next slide, please. Let me invite Amelia into the conversation. Hi, Amelia.
Hello.
In a short period of time, Amelia and I are going to share with you our playbook for accessing capital. And we'll be taking a different approach to the access issue. For us, this is about what's in our control. So this is not a presentation about survival mode. We're not going to talk about the PPP or EIDL. This is much bigger than that. You see, what's in our control is what we know and how we act. So today, we're going to focus on what capital partners are looking for and how you can align your ask with their objective. So I'm in Los Angeles, and I'd like to make a Hollywood analogy to raising capital for your business. Movies get made because of key contributions from writers, directors, and producers. And in many ways, founders are like passionate script writers. And here's where it gets interesting. Scripts become movies because of producers. Businesses become growth companies because of producers. And one of the key responsibilities of a producer is to arrange financing. So what you need to know is that being a successful writer does not entitle you to a blockbuster movie, just as having a solid business does not entitle you to financing. You need to tell your story like a producer. And there are 3 pillars of your story that need to stand out: your concept, operating model, and deal. Hey, Amelia, when you think about your last few deals, tell us, who was the producer? Was it the entrepreneur, an intermediary, a board member?
Yeah, so I work specifically in venture capital. And so venture capital funding is a very specific type of investment, a very specific type of investor that's looking for companies that have the potential to be billion-dollar companies, multi-billion-dollar companies. They're going to exit via a large acquisition or an IPO. And so the types of founders and teams we're looking for is very specific. So for us, a producer is oftentimes the CEO, sometimes partnered with the CFO. And you really want to be able to tell your own story. Many companies in the venture capital space are building something that's never been built before. They're building on technology that's just become cost-effective enough to scale, or the technology's just been created. And so when you're investing, you're betting or you're investing not only on that product and that market, but very specifically the team. And so for us, oftentimes those producers are that original founding team or the CEO and the CFO, which I think is pretty different from a lot of other markets.
That's right.
So, I just think it's interesting. I mean, and Nick, you work in the middle markets and help other folks, right? And so what you're seeing are different types of producers. Is that fair?
That is fair. What you see in companies that in some instances are in the middle market, maybe have a bit of a longer life cycle than early stage companies that are targeted by venture funds. A lot of the companies that I work with are looking for financing from commercial banks, or in some cases, private equity. And similar to venture, you'll oftentimes see the CEO arrange the narrative, but you could have a producer that could be like an intermediary, such as an investment banker, or in some cases, a CFO or a board member participating in the production process.
Yeah, that's really interesting, because in the venture world, it can sometimes be seen as a red flag if you have an investment banker as an intermediary versus the CEO. It can sometimes in these early stage companies be a sign that the CEO might not be up to the job or be able to handle the narrative, and they're sort of the leader of the ship, because they're oftentimes, not always, but oftentimes the founder of these early stage companies. And so I think you have to think about it from your own business. And if you're running a small business, it's maybe a single restaurant, a single entity, you might be going to a community bank or someone else, and so the framing and the story that you need to tell will be very different. So I think who you're going to for capital and the type of capital you need and the type of scale that you see ahead of yourself for the company really sort of depends on it sort of takes you in a couple of different directions in terms of the decisions that you'll make next. Should we jump into the first concept?
Let's do it.
Great. So a framework that I've become very familiar with is it's called the business model canvas, and it's one of several different tools you can use to decide what's the story of your business. People start businesses for all kinds of reasons, but you have to build the story of your business, if you're thinking about raising money or accessing capital in any way, you have to think about how you're going to tell the story to the people that are actually potentially going to give you that funding, whether it's venture capital or some type of debt product, whether you're getting a small business loan. You sort of have to fit into the nomenclature and the familiarity of the people who are actually making those investments decisions every day, because they're the ones who are filtering probably tens or hundreds of inquiries for funding. And so they tend to have some standardized processes. So regardless of which process you're using, I think deciding what's the story and what concept you're sort of building is really important. And so we'll share today the business model canvas, which is on the next slide, and we'll talk a little bit about it. So the business model canvas is, like I said, one framework of many. You can Google business model canvas, and there's tons of free YouTube videos. There's tons of training, and everyone teaches it a little bit differently. But two of the boxes that I love to start with are actually on the right in the middle of the canvas, which is the customer segment and the value proposition. So the value proposition's in the middle, customer segments on the right. And I think that those are two really, really important ones to think about early on, because the value proposition is essentially what are you building? What are you selling? What product or service are you passionate, like the reason that you're starting your business to begin with. And that's the value proposition that you'll then be selling to your customer segment. And there's tons of different examples you could build, but if you're thinking about you're starting a restaurant or a coffee shop for the first time, and you can extrapolate this into any business, whether it's a logistics company, a technology company that's selling into large enterprise, but really it's what's the unique value proposition that you're selling to your customer segment. And if it's a restaurant, for example, you have to look at the menu, the cost of those goods, whether you're running something that's coming from a large food distributor or you're sourcing farm to table. All those things impact your costs and impact how you're probably going to market the business and the customers that you're going to sell to. Depending on all those factors, the menu, the ingredients, et cetera, that's going to change the price of your product. And that's going to, again, alter who those customers are. So are you going to end up selling to a customer base that's near the location that you're planning to open your restaurant in? Is it, are they going to be driving by your business often enough that they'll be able to stop by? Are you going to have to recruit people from entirely different neighborhoods to come to your area? All those things factor into the value propositions, the cost of the thing you're offering, and then assessing whether there's enough customers that can service whatever product or service you're building. I think those are the two things that I think about. And like I said, there's tons of resources online. But if you just you sort of just make a bulleted list. If you get one of these business model canvases online, you print it out, you can just start writing down the different value propositions. I'm opening a coffee shop and I want to source my beans from a very specific area. I'm going to have a very specific process to make them. And you sort of write all those things down and you think, what's the actual customer base that I'm reaching out to? Is it a specific demographic? Is it based on age? Is it based on income level? Is it based on similar interests? And then you sort of tie those different elements together as just an early way of starting to build your story. Nick, do you have certain boxes? Do you use a framework like this? Do you have certain areas that, when people are thinking about their business that you think are most important?
Yes, Amelia, I love the business model canvas. And when I'm reviewing a canvas, my focus goes to customer segments, as you pointed out. And within customer segments, I'm really trying to understand how much do customers care, right? So we talk a lot about the intensity of either the problem or the solution. And then also within customer segments, where are the dollars coming from in order to buy the product, right? So I think about that customer budget, whether it be a consumer-driven business or an enterprise-related business, the dollars are likely coming from a pre-established pool of capital. So I'm always intrigued by the arguments that entrepreneurs will make in terms of, dollars potentially coming out of one bucket into their bucket and why.
No, I think that's a really good point. You think of some large enterprise products like Slack or other tools where the end users might be a group of people that aren't necessarily the decision makers. So you have tools like Microsoft Teams or like Slack, and the end users are the whole population of the business, a group of software developers, a group of marketing folks, right? And they're the ones that are going to be the advocates, but they aren't necessarily the financial decision makers. And you sort of have to build that path into your marketing plan, into your customer segments, because the people who cut the checks aren't necessarily, the end users. And there's probably tons of examples of where that's the case. And I think just using frameworks like this help you start to think about that, because that weighs into all the other decisions you have to make along the road of marketing and what types of sales you're going to do, whether it's going to be outbound, whether you're going to simply run digital marketing, whether you're going to have a sales team. I think all those things are sort of informed by the customer and the value you're bringing to different folks along the value chain.
Absolutely. Thanks again, Amelia, for the outstanding breakdown on the business model canvas, which is really an excellent tool to frame concept. Next slide, please. So if concept is the setting, then your operating model is the actual story of your business. And just as no two movies are exactly alike, no two businesses are the same. However, producers know that investors trade on pattern recognition. Next slide, please. And after years of studying successfully funded and acquired businesses, I think I've captured the pattern and refer to it here as the pay line. The idea behind the pay line is simple. There are 5 reels or judgments being made on your core operations that cut across each functional area of your business, from product to marketing to your human resources. And like a slot machine, a business is viewed as successful when they land as many reels scored as high as possible. So let's take a moment to define each of these reels. Let's start with profitability. So profitability refers to how successfully a business uses its assets to generate a profit. Companies enhance their profitability by selling at a greater velocity than they incur expenses. You know this. And so organizations with higher profitability earn attractive valuations because the market is seeking to maximize the amount of profit earned for their time and capital. Now, predictability refers to the level of certainty that particular business conditions will exist in the future. Businesses can improve their predictability by designing systems that either have repeatable procedures or repeatable outcomes. You see, predictable companies earn higher multiples because they have a degree of confidence that future performance will exist at a certain level. So contrast that with defensibility. And in defensibility, we're really talking about is your ability to ward off future threats from competitors. Companies can offer the product or solution of choice over time and maintain profit margins by leveraging their competitive advantage. And so a defensible organization refers to or achieves higher multiples because the future performance of their current offering is dependable. And then we turn to opportunity. Opportunity refers to an organization's ability to capture prospects for growth. And so companies can cultivate opportunity through compelling market positions and actionable points of view on where their market is headed. Companies with great opportunity earn high valuation multiples because their future financial performance has the potential to be greater than it is today. And finally, transferability. Transferability, what we're talking about is a company's ability to transfer the business to a new owner. Now, I know you don't want to sell. However, here's the point. Companies that are run like they are going to be sold tend to be more efficient. And you can enhance your transferability by reducing dependency on people, relationships, and practices that cannot exist after a sale. Companies with high transferability are more valuable because a new owner can assume the future financial performance of the business without the significant concern of disruption due to the sale. Now, we know.
Real quick.
Yes.
I have a question from Victoria in Texas, and she's asking, is there a particular way to prioritize the pay line? Is there one that weighs more than the other?
Yeah, it's a great question, Victoria. And if we go back to the slide on the pay line, what I want to suggest we do is we think about this almost like a Vegas style slot machine, Victoria. And in Vegas, a random number generator determines the slot machine reels. What we're suggesting here with the pay line is it's consider that you have 3 potential outcomes to keep it simple: high, medium, and low. And so what we're really trying to achieve is a high level across each of these 5 reels. And when you do that, that's really when your company has the potential to hit the jackpot.
Yeah, I think this one's kind of interesting because it sort of depends, at least, again, I'm speaking from the venture view of where you are in company development, right? And so you'll see a lot of technology companies that will sacrifice profitability now in order to take over more defensibility and more growth and more opportunity. And so this isn't something that I certainly don't advocate for running, a business that's not profitable. But there are some cases in some types of companies where you will raise money to grow your market very quickly. And I think really big examples of that are Uber and Lyft, right? The technology was created at a very specific time, and the market opportunity existed to start to replace taxis and to take over more market share. And in order to grow to a size that you were not just operating Uber in New York and San Francisco, but they needed to be able to operate in a small town of Yuma, Arizona that I live in that has a population of 100,000 people. They needed to sacrifice some profitability, and they raised money and they gave up ownership of their company in order to do that, in order to gain market share. And so they were taking defensibility doesn't just necessarily mean IP protection. It means in some cases being so big and that so many people are commonly using you that you're sort of gaining defensibility, or you're gaining more market opportunity in the process. And so I think it sort of depends on the type of business you're building as to which one you're optimizing for at any point in time. But you're ultimately trying to hit high performance, as Nick's talking about, in every single facet. But sometimes just one comes before the other.
Yeah, and let's drill down on that even more, Amelia, because you talk about in some cases where profitability could be compromised. And I would argue that there's an offset for investors if you compromise on profitability. Can we go back to the slide, please? So if profitability is low, then what I would argue is you better overcompensate on something like opportunity. And so in thinking about unprofitable companies like Uber or some tech companies that have gone public, while they don't generate profits, the case that they're making, the producers or the people raising money, are really pounding the table on these tremendous game-changing opportunities in the future. Can you unpack that a little bit more, Amelia, in terms of opportunity as an offset to lack of profitability?
Yeah, and this is a tough one. And again, I don't want to advocate for, depending on the size of your business, but these are specific companies that are trying to be nationally recognized companies, taking over, multi-billion-dollar markets. I mean, these companies are transacting, in the hundreds of millions and in the billions. And so there's a spectrum, right, to companies that are willing to do this for a while. There's, I invest specifically in insurance and financial services companies. And so almost every company when it starts has some degree of lack of profitability, but Uber is betting on a lack of profitability over a 10-year time horizon versus you from depending on the business that you're creating might be able to sustain that for a year or two, but eventually you need to be able to buy the supplies to sell your products and services. You need to be able to pay your employees. You need to be able to pay yourself. And so the trade-off there is often in terms of if you're building a venture scalable or a company that's going to IPO someday, you may be instead of owning 100% of your company, you're giving up portions of that company, 10, 20, 30% at a time, on the fact that on the belief that the company is going to grow so much that amount you're sacrificing is going to be worth the sacrifice, because the company and the value of the company is going to grow exponentially versus perhaps linearly that you see a lot of small businesses grow, where you can successfully pass a company on through the generations. You're probably looking to hit profitability much sooner in life. And there's nothing wrong with any of these businesses. These are all, very, very worthwhile, opportunities to spend your time on. I think I just like to call attention to the fact that the reason you see these stories in the news, they're not unprofitable, and wasting money. They're making a very specific type of I hate to call it a bet or a gamble, but you're taking a very specific type of risk. Does that make sense, Nick?
Yeah, absolutely. Absolutely. And I think, consider this. I think there's another interesting reel here and a common area of investor sensitivity, which is regarding predictability. And that at least with commercial lending and in private equity, there's a real bias toward contractually recurring revenue. And that the other side of the continuum is having no visibility on the pipeline. So I would say, here's an action step to all of our entrepreneurs that are potentially looking to raise capital from the commercial banking system or even private equity, is to look to create as much certainty as possible. And you can do that by, one, establishing contracts with your customers and suppliers, bear hugging repeat customers, and even tracking your pipeline in a CRM. Amelia, maybe give us some perspective in terms of, when you're venture investing, how much stock do you put in predictability, given that, your folks are really trying to create the future?
Yeah, so predictability is hard for very early stage companies, but you want to see the glimmers of a business model that will lend itself to predictability. So you're looking at businesses that have the potential for a strong gross margin. So, how much of every contract you're getting are you actually taking home? And there's, sometimes you're going to be making sacrifices on, you're spending money on engineering and building your team for the first time. But I want to see a path that when this is at a certain stage, when your business is at a certain stage, you're able to bring in, a repeatable and a reliable amount of money. And that's where that predictability comes in contracts, oftentimes in contracts, but there's some types of e-commerce companies that are quite transactional. And so you might see someone selling, one specific product. You might see someone selling a swimsuit. And then you want to understand, you're recruiting people to purchase these swimsuits, and what's kind of the next thing that you think you're going to market to them, so you can continue to drive revenue from those same customers over time. So predictability is very important to us. I think, again, that's some of those sacrificing opportunity for predictability. If you're selling something into an enterprise, actually Salesforce is probably a great example, right? Salesforce is an excellent tool, some type of way to track your customers. But actually the business model of Salesforce is interesting, because you might see a sales team in a large company adopting the CRM, and then they're telling their colleagues in the business, hey, this is a really great tool. I'm using it right now to track sales. But marketing folks can also use CRMs, and other entities within organizations can use, the same tool. And so you build actually additional predictability by making those contracts larger and larger, because you're selling to maybe more people in one group over time. There's just a lot of fun ways to think about predictability. It's not necessarily, locking everyone into 12-month contracts, right? Yes.
I think you make some excellent points there. And in many ways, what you just articulated with respect to those tactics on predictability give you that classic moat, give you that space relative to your competitors, and actually make the company more defensible over time, which is a really nice relationship between predictability and defensibility. Hey, Lori, are there any other questions regarding the Payline?
You read my mind. There is one more question, and our participant, Chris, wants to know if you can give us an example of defensibility.
Yeah, I could start with
Yep.
I think there's, for me, I think of two that come to mind really quickly. Is defensibility for some people means IP protection. So the intellectual property you're trying to protect, and looking at technology companies, which I spend a lot of time with, there is a huge emphasis on defensibility of intellectual property. The risk there is that intellectual property is only as protectable as you have the money set aside to actually fight. If someone does try to build something that's very similar to something that you've already protected. So that is where the defensibility of market and the moat that you're building becomes just as important. And I think that's why you see some of these early stage companies investing so much in trying to grow their market, because if you have that IP protection, which is valuable and important, but you have to complement it with actually growing your market at a reasonable pace, such that your competitors aren't coming in and squashing you just because you spent too much time protecting legally, but not necessarily actually building that customer base. So those are, to me, the two different things. You have to think about IP as a legal thing you can protect, and then also make sure you're building your market and your customer base that really loves what you're building, so that you can protect yourself defensively there as well.
I agree 100%.
Yeah.
Lori, any other questions on the pay line?
No, we're good to go.
Very good
conversation, guys.
Thanks, Amelia, for that great insight. Let's close with our last pillar. Next slide, please. So let's refer to the process of securing capital as a deal. And so here's the deal on deals. Deal making is a business in and of itself. Just like there are nuances to whatever industry you're in, there are norms in the world of deal making. And one of the most successful things an entrepreneur can do when preparing to access capital or do a deal is to approach the process systematically. Next slide, please. So similar to the pay line, I've observed the most successful deal-making entrepreneurs and have captured their system. I call it the deal method. And like our mindfulness meditation, there are 3 simple steps. So I'll walk you through each one of them. Step 1, in deal preparation, we are identifying our target market based on their investment objectives and how they align to our ask. We determine what we're going to offer them by way of an equity or debt structure and terms. We'll also prepare a list of targets with contact information and ideally people in our network who can facilitate an introduction, and finally design an experience that's going to wow them from how we'll structure the initial introduction to all the way through closing. In step 2, in document preparation, we're preparing all of the investor-facing collateral that we'll use to execute our investor experience. Oftentimes, this means we are assembling an online data room to support the capital partners' due diligence around our concept and business model with a focus on financial, legal, and operating diligence. I can't emphasize enough how important it is to have all of your diligence items readily available and organized prior to any capital partner outreach. You see, your preparation here can be a major differentiator and also serve as a way to surface any issues before investors raise them. And finally, step 3, the Investor Roadshow. Now we're ready to actually speak to capital providers. The good news here is we've landed deal prep and document prep, and it really is about execution at this point. You have the list, you have the terms and the diligence data room. You should be more than dangerous for your roadshow. So Amelia, I'd love to tap your experience here. You interact with lots of entrepreneurs over the course of a year. Where do you find that business owners can get tripped up in the deal method, and what can they do with it? What can they do about it?
Yeah, so I think this is a really good one, which is in the deal preparation phase. I think a lot of folks don't know where to go to for capital. I've seen everyone, who's just starting a company look for grant funding availability through to debt products, to raising venture capital. And I think this is a really hard thing to think about. And it really becomes your responsibility as a business owner to think about the company you have today, the company you want to have, 5-10 years from now, and then look at the type of capital needs you need, and then to go find the right capital providers. This I think is where it can be really challenging. I work in venture capital, so I'm looking at a very specific set of founders and companies every day who are raising this very specific type, have very specific capital needs because they want their business to be a certain size or to be in a certain market at a certain endpoint, right? And I think something that we talked about before this session, Nick, is that we all kind of have our own lanes. We know where we know what to look for in the companies that we're looking for. And if you pitch the wrong people, if you're looking for a debt product to grow, from 2 restaurants to 5, But you think that that's probably where your market's going to end. Coming to a venture capital provider, you're going to get no's all across the table because you're just not talking to the right financial providers. And I think that can be really hard. I won't necessarily know where to steer you because I probably only am familiar with the SBA, and I might know some private equity guys, but I won't necessarily know the right person to route you to. And so I think to save you from a bunch of no's, find the right people to talk to. I feel like you run into similar issues.
Yeah, I think it's a great point. And I think you really hit on one of the major challenges for probably a lot of the entrepreneurs in today's session in terms of, where do I go for capital? There are all these different players, right? So Amelia, you're in the venture space. Obviously, everyone is familiar with commercial banks. I've made references to private equity. So maybe we just take a quick stab at highlighting the major differences between capital groups. And one of the ways that I cut the market, and I'd love your view on this, Amelia, is I think about there are some investors that tend to look backward in evaluating a business, and there are investors that look forward. And so if I am an entrepreneur that has a track record and I need funds for the future, then I'm going to rely on those capital partners who have a tendency of looking backward because I have the history to support what they're looking for. Whereas if I'm an entrepreneur that has great prospects for the future, but maybe I don't have a lot of history, then I'm not going to go to those guys that ask me about my last 3 to 5 years of tax returns. I'm more likely to go to a group of capital providers that are forward-looking. And just to put names on those different groups, in my experience, the folks that tend to be looking backward to substantiate a good investment are things like commercial banks and private equity groups. And the folks that tend to look forward or put more stock in opportunity tend to be more of your angel investors and venture funds. But what's your take on that?
No, I think that's a really good point. I think the other point I would add is that you're talking to commercial banks and other lending, loan providers. They are the mechanics of the deals are also very different. So you are taking out a loan and you are paying that money back on interest, but you are not giving up any part of your company. You are owning whatever ownership structure, whether it's a family-owned business and you own 100% of it, that structure is in place when you take on loans, right? When you take on something like private equity or venture capital, you are giving up a part of your business. Often in the venture space, you're giving up at least 20% of your business for that capital in exchange, because we anticipate, if I invest in your company, there is a relationship that we have together. I now own a part of your business until there is some type of liquidity event. So until there's an IPO, until someone comes and acquires your business, often those are the two big exit points with which the company has probably grown in that time. It is more valuable than it was before. I invested when your company was worth $10 million. Your company is now worth $500 million, and now we are both cashing out and both making a bunch of money out of the process. That is obviously a best case scenario, but that is the type of relationship you're forming. When you have a relationship, with a debt product, you're paying that money back, loan style, like you do with a mortgage. The interest rate might be, wildly different, but that's the type of relationship, right? You're owning that business the whole time, just like you're owning your house the whole time, and you're simply paying that money back as your business becomes more profitable, or whatever the structure that you decide to build. And I think that is something that the entrepreneur has to take a lot more ownership of. And then you can think about all the different document preparation and sort of the Investor Roadshow, and you can build sort of a process from there. Whether you're investing locally, you're trying to find, a commercial bank, locally that's very familiar, or actually, and I think this is something that we should speak about just briefly as well, you're going to a specific type of capital provider. We also look at things differently. I think that was something we're actually going to talk about, which is some folks are more industry specific. Additionally, is that something you want to talk about?
That's right on, Amelia. And I think what's interesting is this conversation is really anchored in that first step of deal preparation. I love your point on the difference between debt and equity. That's something that an entrepreneur or a business owner who's saying, I need capital, that we need to figure that out. Really step one, what's the right capital structure? Do I want to, loan versus own, and who's my partner going to be there? And then also unpacking, the details of those terms, because as you know, Amelia, there are different ways to structure a loan, and there are different ways to structure equity. And I think as nuanced as that is, it really goes back to the responsibility of the entrepreneur to figure all that out even before they get to document prep. And then in parallel, I think once you start thinking about those terms, it becomes pretty evident that the world of people that you should be talking to will likely shrink. Because to your point, Amelia, there's a lot of investors and capital providers that do have a tendency to focus on what they know. And one of the ways is by industry. Another way is by size of the company. Maybe you can give a little color in terms of how you approach it at Nationwide Ventures.
Yeah, so Nationwide Ventures, we're an early stage venture capital group associated with Nationwide. And so we're investing only in early stage companies, typically Series A/B, which is just a type of venture nomenclature, which means the company usually has about $1 million in revenue already. And so we're already getting more narrow, right? We're looking at companies that have high growth potential, that already have at least $1 million in revenue, and that are specifically operating in insurance and financial services. And so you'll start to see, as you start to look and you decide, I think I have a high growth potential company that I'm building. I am operating in a specific geography or in a specific industry like insurance. And then you start to find those investors that sort of overlap, their expertise overlaps with the type of company that you're building. And that's that sort of additional level of research you start to do once you decide on the type of capital that you want.
Yes. Before we go into the home stretch, Amelia, I do want to get your perspective on what we're calling the Investor Roadshow, which is really a Hollywood way of saying the meetings that you have with capital providers. I'm curious, when you think about the entrepreneurs that most impressed you during the roadshow, what were some of the things that they did or some of the attributes that they had that really just wowed you in their roadshow?
Yeah, well, and there's tons, right? You could also, Google this online too, which is, the best pitch decks is what they usually call them. They call them pitch decks for some reason. That's when you're actually pitching to investors. It's usually a PowerPoint with some set number of slides in it, and so you can Google sort of the traditionally most typical format, and it's usually 10 to 15 slides. But I find that preparedness. I find the passion for what you're building. So there's an underlying passion for what you're building, because I'm not just investing in your business. I'm investing in your commitment to this particular idea and company. I want to know that not only the company's going to be around for a while, but that you are, whoever's advocating it and leading that fundraise, typically it's the entrepreneur, is going to be around to make sure that the company is going to be successful for a while. When you're in some of these early stage companies, when you're investing in these early stage companies, there's already so many volatile elements. You're growing in a market trying to grow very quickly. You might be building a product that's never been built before. I need some level of confidence, and that's often making that bet on that team. And so I think having that conviction is really important. So I think team and your passion is probably something that I'm indexing a lot more than maybe some commercial bankers might be.
Yeah, that's great perspective. And Lori, I'm gonna ask that we take any questions on the deal method in our Q&A. So can we go to the next slide, please? Amelia and I had one objective today, which is to make sure that you understand what you need to do to raise capital. So if you feel energized, well, you should, because many of you are so close to getting the funding you need to really accelerate your business. It's also fair to feel overwhelmed because there's real work to be done. So here are 3 actionable takeaways from today's discussion. 1, use the business model canvas to identify your strengths and weaknesses. I actually like to color code each box when looking at a company. So if you're strong, color it green. And if you need more support, color the box red. Colors can reveal what investors will likely take away from your presentation. 2, work on your pay line. The pay line is really about mindfulness. There's only so many hours in the day. So why not focus on the areas of your business that will help you raise capital and increase your valuation? Doing anything else is a distraction. And 3, think about the deal method from a capital provider's perspective. Would you objectively do the deal you are proposing if you were in their shoes? This is where empathy can sharpen your deal making. Next slide, please. So Amelia and I would love to hear your questions. So please continue to use the form below to share your ideas. Let's bring Lori back into the fold to help go through those final questions. Hi, Lori.
Hi guys, what a wonderful conversation. I am not an entrepreneur, but I learned a lot today, so thank you so much. We do have a question here, and this came from Jasenia. Do you have a digital document that explains the Investor Roadshow, document preparation, and deal preparation?
That is a wonderful setup, Lori, for the nationwide business solution series. Which Lori is actually going to share some information about. And in that series, we not only spend time unpacking the deal method, but we actually have a worksheet that business owners can use to help guide them through the deal method. So I'll leave it to you, Lori, to make sure that everyone has that information about.
Yes, I'm just going to encourage all of you, and I know Brianna has been engaging on the chat feature, to go to nationwide.com/biglegacies. There you're going to find 3 wonderful 20-minute videos, one of which features the one and only here, Nick Delgado, and that is where you can find all of those additional information. There's also a workbook that goes along with the video, so you'll be able to download that and again help you with all of these different outline items, Jasenia, that you asked about. So thank you so much. Again, nationwide.com/biglegacies. Okay. So here, I believe that we talked about, Nick, you asked Amelia, and she did a great job outlining that preparedness and passion and team are important when you're going out there and doing your pitch. I was asking, actually, either one of you, when was the last time you were really blown away with a fantastic pitch? And what were those elements, if they're any different from the preparedness and the passion, that just go, wow, I definitely want to learn more. This is definitely a firm or a company that I would want to invest in.
Go ahead, Amelia. I'll follow up with you.
Sure. Yeah. So you certainly can't raise money off of passion alone. And so, I've seen a pitch recently that really caught my eye. They had the key highlights of their business, like why I should care about this business specifically in their first slide. And of course, they had to cover everything. They had to cover their market opportunity, their financials, their team, and everything in the deck to follow. But they kicked it off with just a couple of highlights that were just like, this is why this business is so compelling. And for them, that story was about how strong their gross margins were, the growth that they've seen in the last 4 years, what they're projecting. They had a unique insight into the insurance market and how COVID was giving them an opportunity to grow faster in insurance than they had anticipated. So they just put a couple of little highlights, and they had that story ready, and that really piqued my interest. If I'm listening to 10, 15 pitches a day, in some cases, if I'm at a conference, you really need to stand out. And so just finding ways to say like why your company is unique and special and worthy of investment up front, I think that really catches an investor's eye.
And I love the question, Lori. I'm a Hollywood guy, as you know, so I love the sizzle in the presentation, a rock star entrepreneurship team, companies that make a lot of money. That's all sizzle. What I've come to appreciate that is sexy is due diligence and having a really solid, this is going to sound crazy, but a really solid data room, which means you can follow a link, you go online, and there are 3 folders: financial, operational, and legal. And inside of each of those folders, imagine this for all of my entrepreneur friends at home right now, imagine in each of those folders is a really tight and comprehensive presentation of your business along those 3 domains. Here's the reason why I get really excited about sexy data rooms. And the reason is because deals fall apart after the sizzle is over. people go into these data rooms, people go into due diligence, people double click on your financial performance, people go into the weeds of your contracts, people are looking at the nuts and bolts of your operations. And if you don't have a rock solid diligence setup, then oftentimes the deal will not make it across the finish line. So really solid presentations are those that have rock solid data rooms.
Oh, you make a really good point, which is that there are struggles with every single business model. There are always weaknesses. There's going to be something that's not working perfectly. Maybe you lost some early customers, so you had high churn, in the first couple of years, but you fixed it. We're going to find that, especially in the data room. We're going to look at your financial model. We're going to see your past performance, and we're going to ask about it. So if you have the opportunity, usually you might have a first meeting, which is a pitch. Your second meeting might be, walking through the financial model. Have an answer ready and call those things out, because if we have to find it, it's going to ruin that trust, right? Because investing in, especially in venture or private equity, is building a long trusted relationship. And so I think that's such a great call out, Nick.
Wonderful responses. And I guess, Nick, what I'm hearing you say is that the sizzle reel has to be just as good or the movie, right? Because it can't be like those where you see the sizzle reel and then you show up to the movie and it was a complete flop. So the full length has to be just as good. And so those are wonderful. So real quick, I know that we are almost at time. Before we close, I wanted to ask one last question. And let me just take a quick look and see if there's anything else coming through. So Omar is asking us, is it easier to get capital when you work with a company that has a franchise model?
Amelia, do you have any perspective on that?
Oh, I mean, I don't invest in that, and typically in that area, so I don't think I have a well thought out response.
Yeah. So Omar, what I would say is it helps by way of having well-defined operations. So you go back to concept and operating model. If you're operating a franchise, then a lot of the operating questions we're going to assume are going to be in order, right? So then this really comes down to your execution by way of financial performance, right? So you can have a wonderful playbook, but then what capital providers are going to look to is how did you execute on that playbook? And they're going to look for financial performance to justify them likely loaning you money versus putting ownership or equity dollars into your company.
Thank you, Nick. And here's one last question. I know that we dove into what makes that pitch successful, but I think we learned right from the not successful ones as well. So can each one of you give me a quick example of a pitch that you experienced where there was a huge miss, and what was that?
That's really tough. I can tell you that we have to decline investments all the time. We decline 95% to 98% of every one we talk to, and that's just because they don't fit within our very specific model that I think I explained, right? That's the types of companies we can invest in. And so we do try to give that feedback. Not every investor has time probably or will give feedback, but I think just like any first date or second date, it's very nice if the relationship isn't going to work out to give some indication. And I think I do at least try to give an indication when I decline why it was, and it's almost always market opportunity, or it's not in this very specific insurance and financial services niche with which you invest. And so I think you should always ask for that. But I don't have any big gaps. I just think that most of the time things just don't fit into our investment thesis areas.
Yep.
Thank you, Amelia. How about you, Nick?
Yeah, Laura, I would just add that if we were to go to the deal graveyard, there's so many tombstones there that would attribute the death to financial related issues. And at the top of the death list, or what's driving death in deals, is accuracy, especially for smaller companies. Not having accurate financials is a surefire way to not get a deal done. So if you want to avoid the deal graveyard, make sure that your financial records are rock solid, number one. And then number two, invest the time in being able to communicate that narrative. I go back to what Amelia said at the very top of the hour, Lori. She said, hey, that producer, she wants the producer to be the CEO. So you can't outsource, someone coming in to tell your story. And a big part of your story, at least from my perspective, is the financial component. So one, get accurate financials, and then two, be an amazing communicator of those financials.
And the two of you have been amazing communicators today, so thank you very much. I want to thank you because you were very dynamic, very insightful. We got some great questions. I appreciate all of the energy and all of the work that went behind the scenes to make this happen today. So thank you, Amelia. Thank you, Nick. I want to also extend our gratitude to Ramiro Cavazos, Richard Garcia, Brianna Dimas, Laura Sosa, and the event at Everlast Production for their support of today's workshop. You guys rock. Thank you, all of you, for joining us today, for engaging with us through this important economic empowerment conversation. And to close, while 2020 has been a very challenging year in too many fronts, we acknowledge the resiliency of Hispanic-owned businesses across America. Amidst all of the events that have disproportionately impacted you, you continue to show up day to day, doing the work required to keep your business afloat and support the families and communities that depend on you. Thank you for joining us today, y sigan echándole ganas. Nationwide está de tu lado. Thank you.
Hi, I'm Carlos Gill, author and entrepreneur. This is Nick Delgado, president of Black Pen Whiteboard.
I'm Carla Sandoval, entrepreneur coach. Start to identify what stage in business are you in.
Once you find your edge, embrace it, invest in it, and leverage it as you compete in the market against others.